Everyone says just buy an ETF and hold it. But which one? The high growth one that could double fast, or the high dividend one that pays you, or the broad market one that plays it safe? In this video, I've taken 5 major ETFs and compared them side by side. We'll look at total returns, dividend yield, dividend growth, risk, fees, and long-term compounding power. To make it real, we'll project how just $7 a day grows over 30 years with each ETF and what kind of return you can expect from each. And at the end, I'll show you which ETF I think is the best pick, and how that $7 daily investment could potentially turn into an $860,000 portfolio that pays you around $2,600 in monthly dividend income. Before we start comparing numbers and ranking anything, let's take a step back and quickly cover what we're actually talking about when we mention ETFs. An ETF is basically a bundle of stocks put together into one single investment. Instead of picking and choosing individual companies, you're buying a pre-made mix of them. And just like any stock, you can buy or sell an ETF anytime the market's open. But here's where things start to separate. There are all sorts of ETFs out there, each catering to different investment goals. For instance, you've got growth ETFs that invest in companies with high potential for rapid expansion, focusing on upside but with higher risk. Then, there are sector-specific ETFs that target industries like technology, healthcare, or energy, betting on the success of a particular market segment. You also have value ETFs, which invest in companies that are undervalued compared to their fundamentals, and international ETFs that focus on global markets outside the US, letting you diversify across different economies. And let's not forget commodity ETFs, which invest in things like gold, oil, or agricultural products. These track the performance of a specific commodity, offering exposure to those markets. With all these types out there, it's important to understand how each works and what they're trying to achieve. Now, let's break down exactly how we're going to measure them, because if you only focus on things like the current price or what is hot right now, you're going to miss the bigger picture. To really understand how each ETF performs, we need to look at a few key factors. First, I'm looking at total return. That's not just how much the share price went up, it includes dividends too, because at the end of the day, what matters is how much your money actually grows, especially if you're reinvesting those payouts. Second is dividend yield. This tells us how much income the ETF is generating right now compared to its price. A higher yield means more cash in your pocket today, but yield alone doesn't tell the full story. That's where dividend growth comes in. I am looking at the 10-year compound annual growth rate of dividends. In simple terms, how fast are those payments increasing each year? A fund that grows its dividend at 10% annually can completely change your income picture over time. I'll also evaluate risk. We will be looking at things like standard deviation and overall volatility, basically how much the ETF bounces up and down. Bigger swings mean more stress, especially during market dips. I will also factor in the expense ratio. Even small fees, when compounded over decades, eat into returns. And finally, we look at the quality and diversification of the holdings. How concentrated is the fund? What sectors dominate it? Are we looking at financially strong companies? With that framework in place, let's start with one of the most well-known ETFs out there, SPY. SPY is a giant in the investment world. Launched back in 1993, it holds a special place in history as the first ETF ever listed in the United States. Even today, it's one of the most heavily traded and widely owned funds globally. Its strategy is extremely simple. SPY tracks the S&P 500. So when you buy a share, you're instantly investing in 500 of the largest publicly traded companies in the US. From tech to healthcare, financials to consumer brands. It's basically a snapshot of the US economy in one position. The expense ratio is low, at just 0.09%, which keeps costs down. Plus, the liquidity is huge, so it's easy to buy and sell without worrying about big price gaps. In the past year, SPY has returned about 13.45%. Over 5 years, it's gained 74.36%, and over 10 years, it's up a solid 256.57%. That's solid long-term growth with consistent compounding over time. But income is not where SPY shines. Its dividend yield is only 1.05%, which is on the low side. And while the dividend growth over the past 10 years has averaged 5.64% annually, it's still a fairly modest payout. It's been increasing its dividend for 16 consecutive years and paying dividends for 32 years, which shows stability, but the income itself isn't aggressive. When you dig deeper into the portfolio, technology makes up 33.62% of the fund, followed by financials at 12.86%, communication services at 11.01%, and consumer cyclical at 10.6%. The top 10 holdings alone account for nearly 40% of the entire fund. Major players like Nvidia, Apple, Microsoft, and Amazon make up a significant portion of the returns. So while you technically own 500 companies, your returns are heavily tied to a handful of huge tech stocks. From a risk standpoint, SPY has a volatility of 19.34%, meaning it tends to experience noticeable price swings. It also has a low turnover of just 3%, meaning it doesn't change its holdings much, and a nearly zero tracking error, which means it does exactly what it's supposed to do. So here's the takeaway. SPY is a fantastic choice if you want broad market growth. It builds wealth steadily over time, but if you're looking for stronger growing income, that 1.05% yield probably won't cut it. In the end, I'll show you the combined portfolio projections for all the ETFs we've covered in this video. I'll also share which ETF I would choose for myself and how that ETF could turn a $7 daily investment into an $860,000 portfolio that pays you around $2,600 in monthly dividend income. But first, let's look at something much more aggressive, VGT. This ETF is one of the most well-known ways to invest specifically in the technology sector. Launched in 2004, it tracks the performance of U.S. information technology companies. Unlike SPY, which spreads your investment across multiple sectors, VGT focuses almost entirely on one part of the market, technology. The expense ratio is 0.09%, which keeps costs low. The fund manages about $112.52 billion in assets, making it large, liquid, and easy to trade. Over the past year, VGT is up 16.81%. Over 5 years, it's up 92.71%. And over 10 years, it's surged an incredible 634.71%. That 10-year number is huge, reflecting how dominant tech companies have been in driving technology growth, and VGT has captured that momentum directly. But when it comes to income, the picture looks very different. The dividend yield is just 0.41%, which is pretty low. Over the past year, its dividend growth rate has been negative at 17.96%. Over 10 years, it has averaged a meager 1.76% annually. So while the price has exploded, the dividend growth hasn't kept up, making it less attractive for those focused on income. Let's take a closer look at the portfolio. Nearly 99.58% of the portfolio is invested in technology companies, making it highly concentrated in one sector. The top 10 holdings alone make up 58.81% of the fund. Nvidia takes up 17.47%, Apple is at 14.9%, and Microsoft accounts for 12.2%. Together, these three tech giants represent a huge chunk of the fund's returns. From a risk perspective, this concentration shows up clearly. VGT has a volatility of 27.77%, much higher than the ETF median of 16.76%, which is why it gets a D risk grade. The turnover is 8%, and while tracking error is low at 0.47% over 1 year, 0.64% over 3 years, and 0.55% over 5 years, it still tracks its volatile index pretty closely. So, VGT has delivered massive growth, up 634.71% over the last 10 years, but it's almost entirely tech, with more than half of the fund's value tied to just 10 companies. The dividend yield is very low, and growth has been slow and inconsistent. VGT is built for aggressive growth, not for those looking for a balance between income and stability. And if you're looking for a single ETF to hold through different market cycles, that balance starts to become more important. Now, let's turn to something that's designed with higher income in mind. For that, I have VYM. VYM is the Vanguard High Dividend Yield ETF. Launched in 2006, it tracks the FTSE High Dividend Yield Index. The goal here is straightforward: invest in U.S. companies that pay above average dividends. We're talking large, established businesses that generate steady cash flow and share a good chunk of it with shareholders. The expense ratio is incredibly low, at just 0.04%. That might seem small, but over decades, it makes a real difference, as less of your return gets eaten up by fees. Looking at performance, VYM has been steady. Over the past year, it's up 16.83%. Over 5 years, it's returned 62.41%. And over 10 years, it has gained 138.73%. Those numbers aren't explosive like a tech-focused ETF, but they show consistent, durable growth. Where VYM really stands out is in income. Its dividend yield sits at 2.25%, which is more than double SPY's and far higher than VGT's. It has raised its dividend for 15 consecutive years and has been paying dividends for 19 years straight. The 10-year dividend growth rate is 5% annually. That shows you this fund is focused on stability and reliable returns, not chasing massive growth. VYM is spread across 567 holdings, offering broad diversification. The biggest portion is in financials at 22.21%, followed by technology at 16.27%, healthcare at 13.25%, and industrials at 11.47%. Other sectors like consumer defensive, energy, and utilities make up smaller portions, keeping the fund balanced. The top 10 holdings make up 27.12% of the fund. Broadcom is the single biggest allocation at 7.58%, with JP Morgan at 4.15%, Exxon, Johnson & Johnson, and Walmart each represent a little over 2%, while AbbVie, Bank of America, Home Depot, Procter & Gamble, and Cisco round out the list with smaller weights. So while the ETF holds hundreds of stocks, its returns are supported by a diversified mix of sector leaders rather than being overly reliant on just a few names. From a risk perspective, VYM is pretty stable. It has a standard deviation of 9.88, which earns it a C+ risk grade. The annualized volatility sits at 15.4%, which is lower than the ETF median. The turnover rate is 11%, keeping trading costs manageable. Tracking error is low, 0.65% over 1 year, 0.78% over 3 years, and 0.94% over 5 years, which means it tracks its index well. So here's the honest picture. VYM delivers strong current income, broad diversification, and lower volatility. It's built for investors who want steady cash flow and stability, but dividend growth is slower. Over very long periods, slower growth can limit how quickly income snowballs, especially when you are giving up the upside of price appreciation. This leads us to an important question. Is there an ETF that combines solid yield, stronger dividend growth, and competitive long-term returns all in one? In this category, I have 2 ETFs. We'll dive into both over the next couple of minutes. After that, I'll show you how one of these ETFs can turn a $7 daily investment into an $860,000 portfolio that pays around $2,600 per month in dividend income. Finally, I'll walk you through the projections for all the ETFs and explain why this particular ETF really hits the sweet spot. Let's start with the first ETF in this category, DGRO. DGRO is the iShares Core Dividend Growth ETF. It launched in 2014 and tracks the Morningstar US Dividend Growth Index. The focus here isn't just high yield, it's companies that consistently raise their dividends year after year. In simple terms, this ETF prioritizes growing income over chasing the biggest payout today. The expense ratio is 0.08%, which is still very low. You're not overpaying for the strategy. As for the performance, DGRO has done well. Over the past year, it's up around 15%. Over 5 years, returns are in the 60% range. And over the long run, its annual share price appreciation has grown by 195.23%. That's competitive with broad market funds and noticeably stronger than many traditional high-yield strategies. Now let's talk about income. DGRO's dividend yield is 1.97%, which is lower than VYM's 2.25%, but still significantly higher than VGT and slightly above SPY. The real strength here is in dividend growth. DGRO's 10-year dividend growth rate averages 8.59% annually. That's much faster than VYM's 5% growth. Over time, that difference really adds up. Inside the portfolio, DGRO spreads its assets across more than 400 holdings, giving it a well-diversified foundation. Technology represents the largest slice of the portfolio, followed by meaningful exposure to healthcare and financials. The remaining allocation is distributed across sectors like consumer discretionary, industrials, and others, keeping the overall mix balanced rather than tilted heavily toward a single theme. The top 10 positions collectively account for roughly 26% of the fund, which keeps concentration at a moderate level. The largest holdings include Microsoft, Apple, Broadcom, JP Morgan, and Johnson & Johnson, all large, profitable companies known for consistent dividend growth. So while DGRO leans toward high-quality growth companies, it still maintains broad diversification across both sectors and individual stocks. From a risk perspective, DGRO behaves similarly to the broad market. It's not as volatile as a pure tech ETF like VGT, but is slightly more dynamic than VYM because companies growing dividends often reinvest aggressively while still returning capital to shareholders. DGRO shows slightly below average risk. Its standard deviation is 8.35, lower than the 10.01 median, and volatility is 14.68%, also under the 16.76% average. So here's the big picture. DGRO offers a balance. You get solid current income, stronger dividend growth than high-yield funds, and competitive total returns. It doesn't lead in yield, it doesn't lead in explosive growth, but it blends both in a disciplined way. Which brings us to the final comparison, because there's one ETF that combines a higher yield than DGRO, stronger dividend growth than any ETF on the list, and long-term performance that is very competitive. That ETF would be SCHD, short for Schwab US Dividend Equity ETF. It was launched in 2011 with one simple goal: invest in high-quality US companies that not only pay dividends, but have a strong track record of growing them. Instead of chasing the highest yield or the hottest sector, it filters for companies with solid cash flow, strong balance sheets, and a history of consistent dividend payments. This means you're getting income that's backed by real financial strength, not just random payouts. Over the last year, it's up about 13%. Over 5 years, roughly 40%. And over 10 years, close to 149%. While those numbers aren't sky high, they are consistent and they build over time. SCHD isn't trying to double your money overnight. It's trying to help it compound steadily, and with an expense ratio of just 0.06%, you're not overpaying for that steady growth. The cost is extremely low. Inside its portfolio, SCHD holds around 100 companies, which makes it more focused than something like VYM, but still diversified across a range of sectors. You'll find exposure to energy, consumer defensive, healthcare, industrials, and financials. On the risk side, SCHD's volatility sits at 16%, which is pretty close to the broader market. The standard deviation grade isn't perfect, but the real-world volatility is reasonable for an equity ETF. It's not a wild ride. Now, let's talk about income. SCHD's dividend yield sits at 3.35%, which is noticeably higher than SPY and even higher than DGRO. But the real magic comes from the dividend growth. Over the last 10 years, dividends have grown at 10.61% annually. That all comes with 14 consecutive years of dividend growth. 14 years of payments without interruption. That combination, yield plus growth plus consistency, is rare. And that is exactly why it is one of the best ETFs to invest in. Now that we've reviewed each ETF, let's break down the comparison. SPY gives you broad market exposure and solid long-term growth, but its yield is low. If you're looking for meaningful income, it won't get you very far. VGT offers strong returns, but is heavily concentrated in tech and offers almost no dividend. It's all about high growth, low income, and higher volatility. VYM delivers high income and broad diversification, but its dividend growth is slower, which holds back how quickly your income can compound. DGRO focuses on dividend growth, but the balance between growth and income isn't as strong. Each ETF forces you to make a choice: growth or income, stability or upside, yield or diversification. But SCHD doesn't make you choose. It gives you a yield above 3%, with dividends growing at over 10% annually long term. It keeps costs low, avoids extreme sector concentration, and holds profitable cash-generating companies. You get income today and growth tomorrow. Plus, competitive long-term appreciation without betting everything on one sector. It's the most balanced. If I had to pick one ETF to hold for the next few decades, through bull markets, recessions, and everything in between, SCHD is the one that checks all the boxes without compromising anything important. That's why SCHD takes the top spot. Now let's put this into real numbers. Let's say you invest $7 per day into SCHD, which means by the end of year 1, you would have invested around $2,555. This sets the stage for future growth. By year 10, that portfolio is projected to grow to roughly $48,000, producing about $1,000 per year in dividends. By year 20, it's projected to reach around $221,000, with annual dividend income climbing to about $7,000. And by year 30, the portfolio is projected to grow to approximately $861,000, generating around $31,000 per year in dividend income, which equals about $2,600 per month. Notice what's happening. The growth doesn't move in a straight line. It accelerates. Most of the portfolio value and most of the income builds in the later years. That's compounding working on a much larger base. And now the real question becomes this: what happens when you run that same $7 per day through the other ETFs side by side? Here's what the projections show. If your only goal is maximizing portfolio size, VGT finishes far ahead. After 30 years, it grows to about $1.74 million. This is the result of heavy concentration in high-growth technology stocks. SPY comes next at around $954,000, benefiting from broad exposure to the overall US market. SCHD follows at roughly $861,000. DGRO ends near $736,000, and VYM finishes around $461,000. So yes, growth-focused ETFs like VGT and SPY build larger portfolios. SCHD trails them in total account size because it focuses on dividend-paying companies, which typically grow at a steadier pace rather than chasing aggressive price expansion. But portfolio value is only half the picture. Now, let's look at dividend income after 30 years. SCHD generates approximately 31 grand per year in dividends. That's a massive difference, much more than the others. DGRO produces around 5 grand per year, and VYM generates roughly 3 grand per year. SPY delivers only about $700 per year, and VGT produces just $45 per year. While VGT builds the biggest account balance, it produces almost no income. SPY grows well, but its dividend remains modest even after decades of compounding. Dividend-focused ETFs tell a completely different story. SCHD, DGRO, and VYM provide far stronger cash flow, and SCHD clearly leads because it combines a higher starting yield with faster dividend growth. And that's why it sits in the sweet spot for me if I had to choose only one ETF. Want to know how to turn $25 a week into a $1.6 million portfolio that pays over 6 grand in dividends every month? Click the video on screen to find out how.